Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, today we're going through the U.S. market peripheral notes for Monday, March 30th, 2026.
And just a quick note, this video presents a direct, informational narration of the source document.
Okay, before we dive in, we have to start with the initial risk disclosure. It's really important to remember that this information is for educational purposes only, and it is not investment advice. Financial markets come with risk, so you should always conduct your own research before making any decisions.
So here's our agenda for today. We're going to start with the big picture, the market backdrop, and then we'll get into sector performance, specifically semiconductors and AI. Then we'll cover monetary policy, the technical setup for the S&P 500, and the huge topic of geopolitical risks. After that, we'll look at the flow of funds, some core single stocks, and then wrap everything up with a summary and outlook. All right, let's kick things off with Section 1, the market backdrop and macro overview. The subtitle here really sets the tone: a complex geopolitical overhang and a fragile rebound. So the day started with this intense geopolitical tension that was actually driving capital into U.S. assets as a safe haven play. This led to a pretty fragile gap higher opening for the market. But that rebound impulse, it faded, and it faded fast, mostly because of pressure coming out of the Asian markets. By the end of the day, both the S&P 500 and the Nasdaq closed lower, with only the Dow managing to stay slightly positive. Now let's move on to sector performance. The big story here was a valuation reset, and it was centered squarely on semiconductors and AI. It was just a violent flush for the semiconductor space. The main index, the SOX, fell over 4%. And if you look at a key name like Micron, ticker MU, it pulled back a massive 32% from its high. We're even getting reports from Goldman that point to exhaustion from Korean retail investors, suggesting their buying power has really been depleted. And all of this has created a sharp divide among institutional investors about what's next for the memory industry. On one hand, you've got the traditional cycle peak view, which basically says the expansion has hit its top. On the other hand, you have folks like HSBC arguing that we're actually just in the middle phase of an AI-driven supercycle. So two completely different outlooks. Okay, next up is monetary policy. This is crucial because there's been a clear shift in the market's thinking, especially following recent remarks from Fed Chair Powell. It looks like we're moving toward recession pricing. You know, for a long time, the market has been running on this bad news is good news logic. Weak economic data meant a higher chance of rate cuts and stocks would rally. Well, that's over. The new logic is that bad news is just bad news. The fear has shifted from rate hikes to the very real possibility of a recession. Now let's get into the technicals. We're looking at the key S&P 500 support levels and what some are calling the Maginot Line, a critical line of defense for the market. And the weakness is getting pretty severe. The current pullback is approaching that strategic 10% watershed level. What's really telling is that the rebound attempt on Monday morning was so weak, it couldn't even get back to the 5-day moving average. That signals a real lack of confidence from buyers. So here are the key levels for the S&P 500 that everyone is watching. If we see a rebound, the target is the 6,450 to 6,500 area. On the downside, the first support level is at 6,300, but the really critical Maginot Line is down at 6,150, which was the prior all-time high. All right, let's talk about what's really driving the market right now: geopolitical risks and game theory. We're talking about things like supply chain terror and the potential for a black swan event. So let's break down the key risks. There's the threat of an energy blockade that could send WTI crude oil above $100. There's the ongoing rhetorical brinkmanship between the U.S. and Iran. Then there's the black swan nuclear risk, which involves 450 kilograms of enriched uranium. And to top it all off, there's a sense of timeline pressure, as the conflict is now entering week 5 of what's seen as a 4 to 6 week critical window. And to put a fine point on it, Iran is reportedly preparing to charge a $2 million transit fee for every single vessel that passes through the Strait of Hormuz. The market is interpreting that move as nothing less than a form of supply chain terror. So with all that doom and gloom, let's look at the flow of funds and positioning. Because believe it or not, there's a case to be made for some asymmetric upside here, thanks to quarter-end rebalancing. Here's the situation. Trend following funds, or CTAs, has sold about $190 billion and are now holding a $50 billion net short position. But data from Goldman suggests this wave of selling might be close to exhaustion. On top of that, we have the March 31st quarter-end rebalancing and the expiration of about $7 billion in dealer negative gamma. All of that combined should help relieve some of the selling pressure.
Now, let's zoom in on a few core single names and check out some of the unusual movers we saw in the market.
Okay, looking at the table. First, NVIDIA, ticker NVDA, is down 41% from its all-time high, officially in a bear market after wiping out $900 billion in value. It's a prime target for liquidation in this risk-off environment. Next is Microsoft, MSFT, down 26% for the quarter as it gets caught in the broader tech valuation reset. On the other hand, you have Alcoa, ticker AA, which rallied 8%. That's a classic play on fears of supply chain disruption. And finally, Freddie Mac, FMCC, which had a wild day, surging 47% based on a tweet from investor Bill Ackman.
All right, let's tie this all together in our summary and outlook to get the final take on where the market stands. So, here are the final key takeaways. First, U.S. equities are caught right in the middle of a geopolitical storm. Second, the market's pricing logic has clearly shifted to a recession pricing framework. Third, volatility is the name of the game right now. In the short term, the main focus is on that 6,150 support level for the S&P and the effects of quarter-end rebalancing. All of this means a defensive positioning with a preference for cash seems to be the most prudent stance.
And we'll close with the final professional risk disclosure and important notice. This material is provided for informational purposes only and is not an offer or solicitation to buy or sell any securities. All investment decisions involve risk, and past performance does not guarantee future results. Please consult with a qualified financial professional before making any investment decisions.